My name is Ingmar. I'm, as correctly put, CPO and co-founder at Finiata. We are a small business lender, but the small refers to the businesses, not our business. And I would like to talk a bit about machine learning, so AI, and how that, for us, but changes, or has implications on our business model, but also changes the lending landscape in general. So I'm going to talk a little bit about Finiata first, give some context, and then once I'm done with the promotional part, get into machine learning and how that impacts the environment. So we focus on small businesses, and they really make up for the the major part of the economy. They are the backbone, and they very usually operate on fine margins and have usually, or in very many occasions, are faced with working capital constraints. And it's specifically those small businesses that have an issue with working capital that then also have difficulties accessing credit, which would be a solution. This points a little bit to the banking paradox, where you say, okay, a bank is the place where you are being lent money if you can prove that you don't need it. Of course, that doesn't hold true for everyone, but I think the more you go to small businesses who are more on the risky end, the more that is actually true. And as a result of that, we observe that a lot of these small businesses frequently die, which on an economic level bears one of the main reasons for job losses. Alone in the EU, 7 million jobs are lost every year, which are attributable to small businesses closing their business as a result of a lack of working capital. And while focusing on the smallest ones, we focus on the part of the businesses that are not well served by banks yet. And it is specifically that segment that also grows, so the market opportunity basically grows within difficult times like we are in today. And it is, the market itself can be viewed like an iceberg, basically, where banks currently serve the tip. So banks are serving high volume, low risk businesses. And we really go beneath the waterline. We want to serve the businesses who currently do not have sufficient access to working capital, where banks are structurally enabled to serve these segments profitably, hence don't do that. We started with a credit line product, which currently has an NPS of 82, so our customers really like the product. We have a retention of 90%, and we basically lend that credit line with a line of 3 to 8% of annual turnover. So this is roughly the amounts that we lend out. It's just an app. You can access the loan online, withdraw to your bank account, and then repay via direct debit. And now, enough with the promotional bit. So much for context as to what we're doing. If you look at lending from a financial perspective, for the larger loans that are granted by banks, the main driver of the business really is on the cost of funding side. So it is on the cost side, but on the cost of funding. So there, the transactional cost, the underwriting cost, the processing cost, the cost of acquisition for the largest credits really don't bear that much relevance. It's really about interest yields that they generate. For us, it's very different. We are serving businesses with very, very small amounts, right? Hence, the absolute margins that are generated from these amounts are very small as well. To break even on those, to be profitable within that segment, we need to pay very, very close attention to the transactional costs, as well as the cost of risk that we're generating from that portfolio. So the pressure here really is on the cost side, on the cost of risk, processing and acquisition side, not so much on the cost of funding within our segment. And this is also the structural reason I was talking about why current providers in the market, specifically banks, fail to serve that segment well. And this is specifically also the reason where machine learning, now coming to the actual topic of the talk, bears an opportunity and shows a technology that can be used to reduce the cost of risk, but also reduce the processing cost. We can also talk about acquisition, but that is a whole topic of its own, embedded finance, etc., how distribution of credit is changing over time, but that would be for a different talk. Speaking about ML, now this is what we started with. It's a big number, and with data science, machine learning, you always have that cold start problem, which is in applied data science another word for the chicken and egg problem. So you want to serve a segment that is not well served yet because there is no credit model that can cater that segment. So you need to build a model. Well, that's obvious, but you build that model, machine learning, based on observations, right? It's always an empirical approach where you train an engine based on something that has been observed in the past. Well, if businesses are not being lent to in that segment, there is nothing to be observed, right? Hence, you cannot train it. So you need to somehow create the egg, right, in order to get the chicken. And, more traditional or more the data scientists would basically say, yeah, let's just do seeding. So let's just lend to everyone without even having an underwriting policy, right? Well, that's ethically probably not be, doable, but there is another approach. So what we did is we applied a scorecard. So we did basically in the beginning what everyone else was doing. We did a conservative approach, just a scorecard, lending to this segment, and this is the number that we got out of it. Still not profitable. You don't need to be, a finance analyst to know that you will not get profitable if you have 30% losses on your principal. But this was our starting point, and thereby we were still, despite this underwriting approach that we were applying, we were generating defaults because it is a difficult segment, and this is where banks are failing. But then we used these defaults, we used the learnings to train a machine. And so on the left side, the more traditional approaches, they would, take data, usually credit bureau information, yes, sometimes also financial information, in Germany, the BWA, so accounting statements, etc., to underwrite the businesses. We, on the other hand, take an empirical approach. We take a lot more data, number one, but most importantly, we take the observations that we generate from the loan book, from the underwriting decisions that we take in the past, to train a machine to then improve on in the future. Specifically, the data that we're using is in three categories. The main category, obviously, is financial data. So everyone would imagine that, information on the financial performance of a business bears predictability on the business's risk to default. That's obvious, but there is a lot that you can actually do with the financial data that is available today. So speaking of PSD2, open banking, digital bank transaction data, banking history being available to us, we can do a lot with that data, trying to understand it in an automated way, categorizing expenses, better understanding the performance on the cost and revenue side, and then taking decisions based on that. Aside from that, we also take public databases, yes, credit bureau information, yes, also microdemographic data, so how is the economy doing within the specific region that the business is in, within the specific vertical industry that the business is in. As well as behavioral data. So how does the customer actually interact with us? Yes, prior to the actual credit decision as well as after, because risk management doesn't end when the loan is originated. What is also important to note is that ML doesn't mean that you have only a data science team that crunches data, builds a model that then replicates human decisions, but also human teams. You still need the domain expertise. So Finiata, we do have underwriters, but underwriters don't take decisions at Finiata. Underwriters only interpret, understand, analyze past observations to drive hypotheses that are then being used for data scientists to build features and improve on the model. So the domain expertise next to the statistical knowledge and mathematical understanding is still required. It's just being applied to build a machine instead of being applied to operate the business. Now, what is really important if you want to do this well and not apply this after the fact, you need to have that machine learning mindset from the get-go and design your product having ML in mind. So you cannot just take any financial service and just apply machine learning to then improve the performance to the same amount as you could if the product is designed having machine learning in mind. There are some aspects. For instance, you would want to reduce the cost of an observation by reducing the ticket sizes. You would want to learn and train the machine as quickly as possible. So investment capital, a lot more difficult because the observation lies a lot further in the future as opposed to early on. Now, what we have in applying this approach, I unfortunately cannot give the exact numbers towards the end of this, but we have reached, basically, we've gone down from this 30 percentage point mark to very, very well profitable amounts. Yes, the risks did not improve during Corona, but ever slightly so only increased, and we are still very, very well within our profitable margins. And so we're very proud to basically have used machine learning to come into a profitability range where banks and incumbents have not shown that. So this is my last slide. I promise I'm already over time. So if you don't mind, just another 30 seconds. Speaking of COVID, the current situation is only amplifying the trends that we already had, at least those trends that make machine learning as a technology the key point to overcome the economic difficulties. And obviously the first point is clear. People need digital distribution channels because they can't, by regulation or health risk, go to the banks anymore. But more importantly, the efficiency due to automation that the automated underwriting process provides is more and more important when the lending business needs to scale immediately during a situation like we have currently. And also, small businesses don't need credit within 2 or 3 weeks. They need it now in such a situation. So real-time underwriting, immediate decisions are a necessity.